Good morning and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Thursday, April 16th, 2020, and we are pre-recording this Trading Places Live. Currently, futures are pointing to move up at the open. It's fractional, but still up is up. Currently, the Dow Jones Industrial Average expected to open, at least based on futures, maybe up around 0.4%. NASDAQ up closer to about 0.75%, so and the S&P in between. So it does look like we'll get off to a decent start, but between now and then, we do have some economic reports coming up, including initial jobless claims and housing starts. So we'll see whether or not the market can handle the news. It handled the news pretty well yesterday, and we're going to get into that in just a minute. Let's talk about today's agenda. We will get into that daily market recap to start off, and then in talking technically, I want to go over the S&P 500, more specifically the SPDR, which is the ETF that tracks the S&P 500, and just recap a little bit about what has transpired over February 19th. I think you'll find that interesting. Then I'm going to get into a segment talking about the AD lines, the accumulation distribution lines, and how I think that's going to play a huge role here as we head into earnings season. And speaking of earnings season, we'll get into the earnings spotlight. Go over a few companies that that have reported, and take a look at what's going on there in terms of their pre-market action, what we might expect throughout the day, and then get into the upgrades, downgrades, a few of those this morning on both sides, and then we'll wrap up the show with the three you must see. Talked about accumulation distribution. All three of these charts I want you to take a look at today. I think are pretty interesting from an accumulation distribution standpoint, so you may want to stick around and watch for that. But let's go ahead and take a look first at what happened yesterday. So first, we got the Dow Jones Industrial Average down 2%, or almost 2%, 445 points. The S&P 500 down over 2%, back down to 2783, so back below that 2800 level. The NASDAQ down 122 points, or 1.44%, back below 8400. And you can also see trying to move back below and did just barely its 50-day moving average. So we got back up above it and then quickly came right back down below it. I think this is going to be a pretty critical area for our major indices. I'll talk about that more in just a minute. The mid caps fell almost 4%. The small caps almost 5%. So their relative underperformance continues. Check out the small caps now moving back below the 20-day moving average. I was just talking about the NASDAQ battling its 50-day. 20-day is another 300-400 points lower. So the relative underperformance on the SML, the small cap 600 index, pretty obvious there. Looking at the individual sectors yesterday, the weakness came from energy, materials, and financials. Those were the three worst performing sectors. Down anywhere from 4.7% on energy to about 4.3% on the financials. You can see both energy and financials moving back below that 20-day moving average. 10-year Treasury yield was pretty rough yesterday. We'll talk about that in just a second, but that's one of the reasons why we're seeing the financial struggle again, and especially down by more than 4% yesterday. We just can't seem to get anything going, in terms of the Treasury yield. Can't seem to remain consistent to the upside when we do get a push, and that's creating problems for the financials, no doubt about it. Taking a look at a couple of the areas that actually performed a little bit better yesterday, we had healthcare. This has been the relative strength in the market. Healthcare, consumer staples have been a couple of really good areas. Technology's done pretty well. Communication services has done better on a relative basis in most areas. But you can really see the accumulation distribution here on the XLV. Take a look at what's going on here versus, say, something like energy, where we've been going straight down. Even though prices have been coming up, you can see that the accumulation distribution taking another turn for the downside. That's not a good sign. That definitely does not confirm the move up that we've seen in energy. However, in healthcare, you can see we're breaking out the new highs, which I do think bodes well for this particular group. And even if the market pulls back, I look for leadership here in healthcare. And so this is one I'd keep on my radar. Communication services also down yesterday, and healthcare was down. All 11 sectors were down yesterday, but these are the two that actually outperformed on a relative basis. I mentioned the financials and the struggle being real because of the 10-year Treasury yield. Look at the huge gap down yesterday on the Treasury yield. We fell from 7.5 well, 7.5 on the Treasury yield here as it shows, but really 0.75%. We fell 11 basis points yesterday, back down close to 0.63. That means a lot of money rotated into Treasuries to send the yields down that much. That's a big move. This morning, early, I saw the Treasury yields down another 3 basis points, down below 0.61%. It's going to be hard for the market, the equity market, the S&P 500, to sustain a move to the upside when we've got the 10-year Treasury yield continuing to fall, because that's money going into Treasuries. And every dollar that goes into Treasuries is a dollar that's not going into equities. Usually you want to see that rotation. So normally what we would see, and this market has been anything but normal, but normally what we would want to see is the Treasury yield rising, meaning money is coming out of Treasuries. And as the Treasury yield rises, we'd be looking for the S&P 500 to rise right along with it. But the fact that we're rolling over with the yield underneath this 20-day moving average and starting to head lower, that, I think, if anything, is going to put more pressure on equities. So that's why I was talking about, hey, this could be a really critical area for our major indices. One of the reasons is because so much money right now is rotating into the Treasury market, being more defensive. All right, let's move on and talk a little bit about, well, we got a couple economic reports. So before I move on, let me just say that we've got initial jobless claims coming out. When that comes out, along with the housing starts and building permits, to keep in mind, housing starts and building permits is March. These are March numbers. So the beginning of March probably wasn't nearly as bad as the second half of March. But still, I expect the numbers to be down. The estimates are well below February's numbers. And I think they could be even worse than maybe expected. A lot of the economic reports coming in worse than expected. So we may get some economic report pressure to the futures before we get to 9:30 Eastern this morning. So keep that in mind. Remember, this is pre-recorded before those reports come out. All right, let's move on. I want to go into talking technically for a minute. And what I have here is the spider. And what I did is I just summarized. This is where we were back on February 19th. We closed at 336.36. We closed yesterday at 277, right here, 277.76. So we had a drop of roughly 59 points. I guess at 58.60. Now, if you just looked at that and didn't pay attention to what was going on during the market hours, and you just looked at your statements or whatever, you're going at the end of the day, you probably don't really notice this as much. But I can tell you that I've seen a lot of panic sell-offs in my time, and I have never seen one where more than 100% of the entire move to the downside on a net basis, more than 100% of it is at the open. It's the opening bell. These are the net gaps since February 19th. So, some of these days you can see we had big gap downs. Other days we had gap ups. The net of all the gaps at 9:30 Eastern is minus 73. So if we didn't even have the stock market open during the day, and all we did is just, at 4:30, we open it next morning at 9:30 and we close it, the net gaps have fallen 73 points, which would take our spider from 336 down to 263. But we're at 277. So that means that throughout this entire debacle, the whole mess, the virus, all of the economic effects, everything, intraday from 9:30 a.m. Eastern to 4 o'clock Eastern, there's been net buying on the spider. It's gone up $14.50. So again, if we just ignored the opening bell, if you just got out of the market, at 4 o'clock, right before the closing bell, and you just said, okay, when I hear that opening bell ring, I'm jumping back in. If that's all you did since February 19th, and you did it with $100,000, I did the calculation. Right now, you would have your account would be $106,308.50. You'd be up 6% since February 19th if you just were ignoring the opening gap downs on a net basis. I mean, obviously, we've had some gap ups, but the net gap downs, minus $73, more than 100% of the decline that we've seen. And, you know, yesterday we had the gap down, just horrific economic news. And I'm like, this is it. We're going down. And we closed right about where we opened on the spider. I think we were 19 cents above where we opened. So despite, and I don't know if you saw the news that came out yesterday. Oh my gosh, the economic news was awful. Retail sales, horrendous. The Empire State Manufacturing Survey, I don't know if you're familiar with that, but basically it's a survey that goes out to 200 top executives, CEO types, president types, about, you know, in the various industries, but mostly it's manufacturing. And essentially they're asking their opinion on business conditions and things like that. And not only that, but where they see things in the next 6 months. And the expectation was for a huge drop to, I don't remember the number, but I think it was in minus 35, minus 38, something like that. The number actually came in, it was below minus 70. The worst reading on record. So, you know, we already had weak futures. We had the gap down at the open. We had these horrible economic reports. We also have Max Payne coming up. By the way, tomorrow is the end of options for the month of April. So April options expire at the close on Friday. So, and the market, because of this big run, there's a lot of net in the money call premium, meaning that it would behoove market makers to see lower prices. So we've got the incentive for market makers to drive prices lower. We've got the horrible economic reports that came out yesterday. We got the big gap down at the open. I mean, it just seemed like we were ripe to move lower. And I could even pull up for you, if we look at the hourly chart, you know, when we broke out on Wednesday right here, or Tuesday, we moved to this high. Look at the 60-minute negative divergence in play. So we had signs of slowing momentum. We had everything, in my opinion, pointing to a major top. And we haven't taken that top out, by the way. So, and today we got futures up a little bit, probably going to go back up maybe and try and challenge it. But it just seems to me like we've got a lot of different signals that suggest we're going to go lower. And yet the market continues to trade well during the day. Everybody, just about everybody, thinks that we're going to go back down. Now, some think that this is the start of 1929 all over again. I think that's hogwash. I think the market was in much better shape. I don't think this is the end of an economic cycle. I think that was the end of an economic cycle. I think there are a lot of differences. This is a one and done. We've got to get past this crisis. We had a great economy coming in. I think once we're past it, we'll have a very strong economy on the other side. I think we'll have a very quick recovery, but there's going to be some damage here. There already was. The market looked ahead, didn't like what it saw. It was very uncertain, and we sold off massive fear, hit a bottom. And we're starting to get a little bit more clarity. We don't have a lot of clarity, but we have a little bit more in terms of, at least now we know that the spread of the virus is slowing. Now, how we handle it from here, who knows? And I'm not a health expert. I'm not going to talk politics. I don't know how it all is handled. But what I do know is that at least one of the major uncertainties, which was, you know, can we contain the virus, has been answered, or is in the process of being answered. It is slowing. The numbers are showing it's slowing. So the market's been, you know, feeling better. But to think that we're not going to go back down at all, I think probably would be taking a bullish case that I'm not sure is justified just yet. But I do like what's taking place during the day. I'm not going to lie. I mean, when you got a lot of gap downs, this is a lot of gap downs. There's a lot of fear. There's a lot of economic damage, and still somebody is buying. That is a good sign. It was nothing like this back in 2008. I can promise you, about 80% of the move down in 2008, when we had the big move down, about 80% of it was during the day. Only 20% of it was gapping down. So anyway, I just wanted to point that out. I think that's very interesting. And it leads into my next topic, which is accumulation distribution. There are a lot of companies that, to me, appear like they're being accumulated. The overall market, I just showed you the spider. that to me is a sign that there's accumulation taking place. We're not selling off. It's not mass distribution from 9:30 to 4 o'clock. There's accumulation from 9:30 to 4 o'clock. Somebody is buying. And so what we're seeing is a mixture. We're seeing a lot of industries being, gapping down and then continuing to sell off. You can think cruise lines, airlines, so forth. And then you've got other areas of the market like healthcare and some of these companies that are going to benefit from stay at home, Netflix, Amazon, Zoom, Peloton, which is a company I've mentioned multiple times. These companies are being accumulated heavily, and you can see it in their accumulation distribution lines, AD lines. So I thought what I would do first is just pull up some companies here that are going to be reporting earnings coming up. And this is what I'm looking at now in terms of earnings. I'm still looking at relative strength, but I want to see strong accumulation distribution. Actually, before I even get into this, Johnson & Johnson had a pretty nice reaction to its earnings. It came out with earnings. Look at this move to the upside. Look at its accumulation distribution breaking out to a 52-week high before the earnings came out. That's the kind of thing I want to be looking at. I want to see not only relative strength, but I also want to see the strong accumulation distribution. ISRG, Intuitive Surgical, I think reports later today after the bell. This is a pretty strong looking accumulation distribution line on this stock. Then when you look at the relative strength, it's been trending higher relative to the pharmas. It's got this one little peak to take out, but if you look at where it is right now on a relative basis, with the exception of mid-March, we'd be right at a 52-week relative high. So, oh, wait a second, that's Johnson & Johnson. My bad. Let's pull up ISRG. I wanted to see the relative strength there. Okay, relative strength on ISRG is more flat. It's not bad, but if you look back over the course of the last year, or at least 11 months, I would say it's kind of like right in the middle. So there are going to be some others that look better. I will say, though, that its peer group, medical equipment, strong for sure relative to the S&P 500. So you got a decent stock within medical equipment, but medical equipment's a very strong area. And as I mentioned, when we look at the accumulation distribution on ISRG, we do have a strong number there. So I'd be looking to see if we can get a breakout above the 50-day and get through 520 on Intuitive Surgical, but this is one certainly keep your eye on. Tomorrow morning, we get Procter & Gamble. So let's take a look at Procter & Gamble. Procter & Gamble accumulation distribution, just kind of so-so. Pretty good action, though, and I would have to say that on a relative basis, this one's going to look pretty good. Yeah, relative to the personal products area, you can see close to a 52-week high, definitely uptrending. And again, if we go back to that accumulation distribution, actually, I'm just going to add this onto this chart. Let me just add accumulation distribution. Okay, so now you've got the accumulation distribution. Actually, I can even make it a little bit bigger. Okay, so now you can kind of look at all of it at the same time. So you got accumulation distribution, which has been on the rise. I mean, you do have prices going lower, and the AD line is rising. That's a positive divergence, according to Mark Chaikin, who developed this indicator. That's one of the things he looks for is lower price, higher AD line. So it's certainly not one of the best ones out there, but it's not bad. And when you consider that it's a stock that's showing relative strength and it's not far from its high back in February, I think that ought to tell you something. I think the market likes PG. Now let's take a look at Schlumberger, which is in the energy area. And accumulation distribution, actually among energy stocks, this one isn't that bad. It's been kind of sideways for the last several months, but you can see on a relative basis, this is not a very good stock relative to its peers. You can see right here, it's not been one of the worst ones. Actually, it was pretty strong in March, but the group has been horrible. So I've kind of got a so-so accumulation distribution and not a great group. So I'm not going to be as bullish going into an earnings report on Schlumberger. Let's look at KSU. This is a railroad, Kansas City Southern. Now here you see a stock that's going down, but accumulation distribution held up very well. And when we started moving back higher, we broke out on accumulation distribution. It's also one of the stronger railroads. I would expect Kansas City Southern to have a pretty nice report. Going into next week, I'll give you a couple of these. How about CDNS? This is Cadence Design Systems. Look at the accumulation distribution here. Very, very strong. Even when it was going down, it was breaking to new highs. Look at all those hollow candles. That's where you see that accumulation during the day. That's what I was talking about, you know, the spider going up during the day. That's what happens. You see a lot of these hollow candles, and that results in a stronger accumulation distribution. Company is starting to strengthen relative to software, which is good, heading toward its earnings report. I think Cadence looks pretty good going into earnings. How about Halliburton Energy? Now, let's take a look at the different side of accumulation distribution. Heading lower, printing new lows, moving back up in price though. So price is going up, accumulation distribution is not. Why? Well, tell me how many hollow candles you see in this chart. Not very many. Most of them are filled candles. That means we are seeing distribution during the day, as opposed to hollow candles, which would indicate accumulation. Stay away from these companies that are not showing accumulation. I would be really careful. Does that mean every one of these is going to go down? Of course not. No signal is 100%. But in this market environment, I would be very careful of these companies that are showing poor accumulation distribution lines. Okay, I just want to mention one thing to Earnings Beats members, that later today, I am going to be unveiling a short list for the AD line. So it's another AD chart list, but this time it's for shorts. It's going to be stocks that are weak in terms of relative strength and also have weak accumulation distribution lines. So we'll now have the strong AD line chart list, which has 354 companies on it that has very strong accumulation distribution and also strong relative strength. And now we have 250 companies on this weak accumulation distribution line chart list. So I'll get all that information out to you in the daily market report today. For those who might be interested and would like to take a trial out, just go to earningsbeats.com, sign up for a $7, a fully refundable $7 30-day trial. And if you're an extra member or above at StockCharts, you'll be able to download those two chart lists. All right, let's keep moving on here. I want to get into the earnings spotlight. So one of the companies that did report today was TSM. So this is Taiwan Semiconductor. I'm going to just go over here and show the pre-market action so that we can see where it is. It's up about 4% here in pre-market, so it's getting a nice reaction. They did come in better than expected on their bottom line, 75 cents versus 66 cents. This is in the semiconductor space, and this is a company that you can see that accumulation distribution line has been going up while prices were going down. That's a pretty good sign. And then you've got a company that recently, now it hasn't been great here over the past 30 days, but a month ago, this was a stock that was at a 52-week relative high to the semis. So I wouldn't say it's one of the better stocks out there, but it's not a bad stock, and it is getting a positive reaction to its earnings report. Okay, let's see. Let me do one other one here. How about BK? Because all these banks really having a hard time. You can see Bank of New York, Mellon, does have a strengthening accumulation distribution line, but it's been a somewhat of a weak performer versus asset managers, which is where this one's classified. And you can see that the asset managers has been weak. So with its earnings report today, the company is up about 4% also. So up roughly $1.30 to around $36. Going back to that chart, $36. Just still got I would say this one's maybe trapped right now a little bit between gap support at 34 and the recent high at 38. Let's see which way breaks. All right, upgrades and downgrades today. I'll just show you CGC, Canopy Growth, was upgraded today. Stock, I don't know, looking at the accumulation distribution, I'd be really careful. One stock that was downgraded in the same area is Tilray, TLRY, and Tilray, same thing. Accumulation distribution has been very weak. So it's being downgraded. You can see there were like 3 hollow candles here, but really not many hollow candles, meaning there's not a lot of buying taking place during the trading day for these companies, and that bothers me. Other upgrades, a couple gold stocks, Kinross, KGC, and Yamana, AUY, but Newmont was downgraded. Other downgrades included Ciena, CIEN, Square, and Twitter. All right, let's take a look at the 3 you must see to wrap this up. Talked a lot about accumulation distribution today. So I want to go through and show you the 3 that I wanted to pull up. Now, JBHT, this is JB Hunt. This is a trucker. Truckers have been doing very well, surprisingly, throughout this period of late, really the last 7-8 weeks or so since this whole virus thing began. And when you look at the stock, the accumulation distribution strong. Now, this isn't one of the best truckers out there, but it does have a strong accumulation distribution. It is trending above its 20-day. The PPO's gone positive. Really is not a bad-looking chart at all, even though, like I said, there are others out there. And maybe ODFL might be one that's looks a little bit better on a relative basis. Now, the AD line doesn't look as good, but I think if we pull up the relative chart, you'll see that ODFL has actually been one of the better stocks within the truckers. And when I go back to JBHT and look at that on a relative basis, you can see it going the other way, although it did have a nice move here over the past couple of days. All right, next up, how about eBay? eBay has all of a sudden started to take off on the accumulation distribution. Look at this move. I mean, I was worried about this stock 3 weeks ago, but all of a sudden with this move, look at all of these hollow candles. 2 filled candles, 1 black filled candle here. But for the most part, there's a lot of accumulation taking place right now in eBay. Now, it's got some overhead resistance to look out for to the upside. But overall, this one looks pretty good. Now, let me show you one that doesn't look so good. Take a look at Dow Holdings. Look at this push to the upside, and look at the accumulation distribution just keep going down. See all these tails to the upside? Failures to sustain moves to the upside. That kills you with the accumulation distribution. Also, a lot of filled candles, including yesterday. Dow, I'd be really careful about. Those are your 3 you must see. That's it for the show today. Appreciate everybody listening. Have a great weekend. Be safe out there. See you next week. Happy trading.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.